All right, this is brief exercise 4-4, and in conjunction with that, we'll be doing brief exercise 4-5. This can be found in your textbook on page 177. What they're giving us is the ledger of Swan Company, and they want us to prepare the closing entries, and in addition to that, post these closing entries to the T accounts, and then get the total balance for those accounts. So let's see, here I'm putting in the information in this Excel spreadsheet. Right here is the information out of your textbook. And what I'm going to do is, like I said, I'll do both of these problems together. So in brief exercise 4-5, they're asking us to post the information to the T account. So why don't we just go ahead and take these balances and plop them in there. A capital account normally has a credit balance. Remember the equation, assets equals liabilities plus owner's equity. Owner's equity is on the right-hand side of that equation, and right means credit. So it normally has a credit balance. So our capital, I'll put the amount right in here, 30,000. And that's our balance that they're giving us. For the drawing account, drawing accounts have debit balances, and so I have a debit balance of 2,000 that I'll put over here on the left-hand side of this account. Let's see, we have service revenue of 50,000. Service revenue, any type of revenue account normally has a credit balance. So I'm going to assume these all have normal balances unless they tell me otherwise. And you want to assume that with all problems. Salaries expense, any type of expense account normally has a debit balance. So let's see, salaries expense is 27,000. And then supplies expense, normally again expense has a debit balance, and that's 4,000. All right, so we have our beginning balances in those T accounts. Now let's close our general ledger. There are 4 steps, 4 entries that you need to make when closing your general ledger, closing out your accounts. Step 1 is to close out all your revenue accounts. Like we have here, our service revenue is 50,000. What I'm reflecting in the T account is that it has a credit balance. In order to close that out, or the term is to zero out that account, I need to have a corresponding debit to the service revenue account for 50,000. Once I do that, they'll net against each other, and that account will now have a balance of 0. So what I want to debit here is my service revenue account for 50,000. And then what I'm going to credit is this new account that gets introduced in this chapter, chapter 4, and it's the income summary account. You just want to think of that as the bucket that you're just going to throw all your revenue and expenses in to see what it comes out to be. All right, so my service revenue is 50,000. I'm going to credit then my income summary account for 50,000. And why don't we post that? So here I have 50,000. And that'll come out to 0 in my service revenue account. And then here I have a credit to the income summary account of 50,000. So if I had no expenses, I currently have a credit balance, which my income would state that I have net income, not a net loss. All right, my next step is to close all the expense accounts, and I have them here, salary expense and supply expense. Those are the accounts I need to close out. They normally have debit balances, and we have it reflected here. If I want to zero them out or close them out, I need a corresponding credit for that amount. So for salary expense, I want a credit of 27,000, and supply expense, I want a credit of 4,000. And then what I'm going to do again is throw these expenses into the income summary account. So let's first reflect our credits. All right, we have salary expense and supply expense, but now this total here of 31,000, I want to debit into my income summary account. And now my journal entry will balance, right? Oops. was bold. What I want is a color. Okay. And so my income summary account will be debited for 31,000. Let's post that. So I have in my income summary now 31,000 as a debit, and I have a credit to salary expense of 27,000, and that'll zero out that salary expense account. And then our supply expense would be 4,000 as a credit. And again, so now you can see my revenue and expense accounts all reflect zero because I made a corresponding entry to zero them out. Okay, now our third step is to close out the income summary to our capital account. Well, let's see, what do we have? We have debits of 31,000 and a credit of 50,000. So my balance here, let me put it right here. I'll draw a line so I can get a balance. So, oh, sorry, I'm doing this on a laptop and the mouse has a tendency to jump. All right, so let me just take the difference between my credits of 50,000 and my debits of 31,000. So I have a net credit balance in my income summary account, and that states that I have a net income. So we have in our income summary has a credit balance of 19,000. If I want to zero this out now, I would have to debit this for 19,000. So my debit to income summary is 19,000. And what I'm going to credit is my capital account. Remember, just like your owner's equity statement, when we prepare that owner's equity statement, we start with our capital balance and then we add in any net income or any net loss. We'll also we'll subtract out any drawings, and that's exactly what you're doing here. So here I have my income summary, has a credit balance. Oops. That was the formula. So I'm going to debit the income summary for 19,000, and that means I'll credit my capital account for that same amount, the 19,000. Let's post that so we can see. So here now my income summary will be zero. So this is step 3 where I zero out the income summary account. And then, let me just use the arrows. And then what I want to do is in the capital account reflect that credit of 19,000. Okay, so we have that posted. And then finally, the last closing entry that you want to make is to close out this drawing account, which we're going to close out to the capital account. All right, so my drawing account has a debit balance. That means in order to close that out or make it zero, I'll have to credit the drawing account for 2,000. And then what I want to debit is my capital account. Drawing, it has nothing to do with income, and that's why you don't dump it into the income summary account. Remember, your income is calculated by taking revenues minus expenses. So our drawing account is actually drawing from the capital. So we're going to debit our drawing account for 2,000. And that's how we'll close out that drawing account. So let me post that. So in my drawing account, I have a credit of 2,000. And as you can see now, my debits and credits will make this account come to zero. And that's what I want. At the start of my new operating period, I want to close out all the revenue, expenses, and the drawing accounts. And so I'm going to reflect, finally, this last one, D Swan drawings of 2,000. I'll debit that. Okay, and then that's complete. And if we looked at our balance in our capital account, again, let me put a total here. And what I want to do is total up my credits. Where's the plus sign? There it is. the 19,000. I'll add the 19,000, but then I want to subtract out the 2,000 in drawings. All right, so our capital account had a beginning balance of 30,000, and now at the end of the year, when we close it out, we'll have an ending balance of 47,000, and that's what your owner's equity statement will reflect. Okay, so that's both of those problems, and that was on page 177.